Hello traders, and welcome to the weekend update here for November 19th, Sunday. So as you know, last week, our equity curve for the alert service definitely took a hit. It was, we had massive up moves in the market. The rut was up over 5% in a single day. That's virtually unheard of. The SPX wasn't too far behind it. So when you're in delta neutral trades like butterflies or condors, things along those lines, and you get massive up moves like that, it certainly puts a strain on options positions. The closer those positions are to expiration, and the bigger they move, the more it's going to hurt. And what added to this problem was gaps. So it wasn't that our market just moved up. It was that our market moved up significantly, moved into a resistance area where a person might have expected a little bit of a pullback, which is why I didn't adjust a couple trades. And you can go into the log below, those of you that are members of the alert service, go into the closed trades and take a look at the video that I put together where we go back and I kind of go back and analyze what could have maybe been done differently in the main trade that was a loser at that time. It's always good to learn from your winners and from your losers. And, at the end of the day, when you have a massive up move into what looks like resistance and you don't adjust because of that, which I didn't, and then the next day the market gapped up significantly because there was a report that came out that morning that was perceived good. And then we not only had a massive gap up, but then again, the rut ran 5% from there. It's just difficult, again, with delta neutral trades. So that's what did this for us. Now, this last week, there's been a couple trades that are, starting to give us a little bit of rebound, going to have some recovery here. So it's going to be a little short-lived because there is another trade hanging out there that'll be problematic that we'll look at in a minute. All that said, for the last year, the alert service is still up. On average, at most, we'll have about $12,500 in risk. And so that would be about 100% return on our money. And we're up over that. The alert service is up over that despite this significant pullback here in the last couple weeks. So the goal here is total transparency. I want people to learn. They can learn from winning trades. They can learn from losing trades. And I think as all of you that are members of the service know that you can go into, once you log in and you see our live trades open, you can go to the closed trades area. And if you're not familiar with that, let me get back out of my drawing tool there. If you're not familiar with that, we've got, of course, the index options alert service here with all of our open trades. And then there's also the whole closed trade archive section where you can go look at probably well over 100 trades that represent or make up those results that I just shared with you. And every one of these trades has videos that I did real time in the opening, the adjusting, and the closing of those trades. So that's part of what every member to the alert service gets, is they not only get the current trades that are open and my explanation as to why I'm opening them, how I'm adjusting them, when I'm closing them, etc., but they also have all of that historical information to learn from as well. So looking at our current open trades, Starbucks is getting moved to a closed trade here. Starbucks, it was an earnings trade. It was a bonus trade that I shared with the students in the class here. And that trade ended up essentially a scratch. It ended up down just slightly, but I went ahead and closed it out. It was down significantly at one point. Target also at one point was a max loss trade, but I was able to turn that one around to over $1,000 winner in this particular case. So that was, there was a lot of adjusting that went into that one, and I did a summary video that people can look at. Let's see, I'm trying to think where I put that here, but right here. So this kind of walks through the entire process of that trade, the opening, how the target gapped up well over 10% against the calendar trade I put on. The key was that this was a calendar trade that gave me time to adjust this trade. That's why most of you probably know that the calendars and diagonals course that I just released, the calendar or the diagonal is one of my favorite earnings trade. Much preferred for me over a butterfly, a condor, etc. And again, that particular class, a deep dive calendar and diagonal course, is I think close to 10 hours of content, and I get into all the nuts and bolts as to why that is and how to put those trades on, how to adjust them, etc. So if you're not familiar with that course, certainly go take a look at it. I think if you're at all into earnings trades, it's something that you should take a look at. Then let's see, our wheel trade, I'll go through all of these in a second. eBay, I closed the eBay trade for a slight gain, not significant. I think it was under $100, something like that. So after those closings of those trades, this is the equity curve here. And then let's take a look at the current open trades we have, because one of them is problematic, and it will be closing here this next week. That's this one right here. The Google earnings trade, ignore that. That is not correct. Let me just refresh. Sometimes on the weekends you get some very odd numbers that show up here, and you need to go in and kind of refresh. So that trade is up just about $900, and that is the wheel trade in Google. This trade was a trade that could have been down significantly more in that gap up. We had a call spread on this trade that I decided to close and essentially lock down the loss on this trade. Had I left that open at the beginning of last week and we had gotten that gap up that we had gotten, this trade could have been down almost double that amount for what could have been an entire loss. As it is, this trade will probably end up a loss, and here later at the end of this next week when it expires, it's going to ding the equity curve again and kind of dip it back down. But this is a remnant of that massive move up that we encountered. And again, we'll look at a chart here in a couple minutes and take a closer look at that. Let me get this up here. This particular trade continues to do well. I think it's actually up a little more than that. Again, we're over the weekend where the bid-ask spreads get a little wide, so the reporting here can be a little bit off, but this one's pretty close. It's probably $300, $320 up, and there will likely be another one or two adjustments in here if our market continues holding up here. What I will likely do through the trading is I will look to raise this wing a little bit more and also reduce our risk in the trade by raising that wing through some adjustments. And again, the goal here is that's going to reduce the maximum risk that we have out there in a trade. And at the same time, it's going to raise our profit potential if the market stays high or stays up above, in this case, about the 43.50 mark, which I'm expecting it probably would at this point. The 12-1 trade over here, this one's in good shape. You can pretty much ignore that structure there. That structure is essentially worthless at this point, but I will largely leave it intact because if we do get some hyperinflated down move, at least over the next week or two, this structure will probably gain in value again, but it would have to be a pretty big down move. I mean, 150 50-point down move over a couple days. But in our current market, that's not unheard of in our current political climate, etc. So there's no real reason to close out that spread because I can't really get anything for it at this point. So we're just going to leave that one intact. And then, over time, if the market continues up, we'll probably move that wing up a little bit, maybe move this wing up a little bit, reducing our risk in the trade and increasing our profit potential. And then this one down here, I've been a little reluctant to do much with it because, it's out at this point. It's still out over a month before it expires. And I still feel like our current market is maybe a little bit frothy or overly exuberant, given that we still have some debt ceiling issues coming into play. We still have a lot of political things that are in play out there. So I do need to probably adjust this later this week if our market kind of holds up in this range. But I'm not sure that we might not get a little bit of a pullback here, which would be good for this particular trade. So, and then if we do get some pullback, if we do get some volatility that creeps into our market here this week, I'm going to look at opening another new trade, at least one, possibly a second one. Again, if our market cooperates and takes a move down with some increase in volatility that I would expect and or like to see at this point. Now, if we come over and look at our market, so this is, let me move my face out of the way here. So a couple things to note in my opinion, looking at technical analysis. And technical analysis is just kind of a guide. I think, it's kind of like those, I forget what those pictures are, the Rorschach pictures or whatever that a psychologist holds up that says, what do you see here? And some people see rabbits and some people see butterflies and some people see clowns, whatever it is. So technical analysis is somewhat similar to that. We're looking for patterns that a lot of people might see. And the more people that see and recognize a specific pattern, the more likely that pattern is to play out or have impact on traders out there in the real market. So one of them that I definitely see here is I feel like we are up here at a point of resistance. We haven't made new highs yet, but we are approaching them. I think new highs would be illogical in our current market with higher interest rates, all the political issues that are out there, etc. So it surprises me that we're up as high as we are here. I was expecting that we were going to get up into this range here and then likely get a pullback. And I was actually expecting that we might even make a lower low there and that we would stay essentially in a channel like that. But obviously that channel broke with some good economic news. That economic news basically is making many traders and investors think that the Fed is not going to increase rates any further, possibly ever in the foreseeable future, and that they may actually now have ammo to drop rates a little bit. So investors may be jumping the gun a little bit there to make those assumptions, but there's certainly now viable data that indicates that that's certainly more of a possibility than it was a couple weeks ago. So that's the reason our market largely jumped up the way it did. And again, pay special attention to that massive gap right there. Now, this is in the SPX. You had that big gap and run. And then if I go and I pull up the rut here, if I go and pull up the rut, we can see that gap is even much more massive here. It was a gap and then a huge run. So again, we went from 1675 up to 1825. in a very, very short amount of time, with, again, one day here being over 5% in a single day. That's just unheard of for the rut, which is largely the banking indexes and things like that. Those types of stocks generally just don't move that way. So in looking at both the rut, if I were to look at technical analysis on the rut, I would kind of put a line across here, which is pretty significant with these various points of resistance. So I would think that those are going to continue to act as some resistance. May not. And I would think, going back to SPX, that again, we've got similar situations in SPX, where I would think that this would be some resistance in here. And that we would largely be looking to maybe some sideways chopping, kind of where I've drawn these lines here, the 4,500 mark down to 4,350, somewhere in those range, and maybe see something like this. That said, end of year, you often have what's called the Santa Claus rally, where people are buying into the end of the year, and that could shoot things higher. I know I'm being very non-committal here, and I'm just trying to explain all the different thought processes that I'm seeing and hearing out there as I talk to other people and read other things about the market, etc. My own personal read is we're probably going to have some resistance here, probably going to have some support here, and that we will largely remain in a range there. If we break out here, we're then going to be pushing new highs at 4,600. If we get that little breakout above like 4,520 or so, and it sustains a day or two, then I think we're definitely going to 4,600. And if we pop 4,600 before the end of the year, we're off to the races. And our trades, the setup, the structure of our trades will need to reflect that. We need to reflect not only the upward propensity in the market at that time, but also the lower VIX. I mean, our VIX is way down there again. And if I come and take a look here at a chart of the VIX, I mean, look at that massive drop in the VIX as our market shot up. VIX had been trading up here around 23, which is great for those of us that are sellers of options, and we're selling premium. And then the combination of this massive drop in volatility combined with the massive up move or jump up in the market, not only did the jump up hurt us, but the drop in volatility is also painful, because when you go to make adjustments, you can't get as much premium in each one of those adjustments that you make. So it's kind of the upside moves in the market are kind of a double-edged sword, in that it not only hurts because we're running to the upside, and many times we will have a structure that has an upside portion of the tent, but in addition to that, as we're trying to adjust our way out of that, we're getting less and less premium for the moves we're trying to make because volatility is significantly lower. In a big down move, when you have on butterflies, condors, those types of trades, volatility spikes hugely. So when we go and adjust our downside trades, we adjust the wings that happen to be on the downside, we're getting more premium as volatility goes higher. So when we make those adjustments, we're usually able to do better in those adjustments and position ourselves better in those trades, again, just because of the more massive amounts of premium we're able to take in. So this has been a little bit longer weekend update, but again, wanted to share current thoughts on the market with everyone. Hopefully you find this useful. Those of you that might watch this on YouTube, please like, subscribe. I do look for questions and comments there, but this is really designed for my students in the Trade Alert Service. They're the ones that see it first, and they're the ones, of course, that get all of the trades that go into this. So I do like to share it with everyone else just so you can kind of see what my students and I are doing. So that's it for today. Thanksgiving's coming up next week. It's going to be a short week, and a lot of times there's not professional traders in the market at that point. So unless there's some significant moves, I might put on a new trade, but largely kind of steer clear of the markets when the professionals aren't in there, because the retail traders can do crazy things that aren't expected, and they come in mass and either sell the market down or buy the market up, and without the professionals in there, when the professionals come back the following week, then they will often take advantage of whatever the retail traders did. So again, need to be a little careful this week. If I put something on, it will probably be in smaller size. So that's it for today. Take care, everyone.